Kevin Carter, we're delighted to welcome all the way from California today. He's come with Dr. Burton Malkiel, who is one of his great investment heroes, as he is for many of us. And he's going to reflect on some of the issues that Dr. Malkiel raised in his speech earlier today for us on the impact on emerging markets investments and on ETF investments as a vehicle for those markets especially. Kevin, welcome.
Thank you all for being here. Thank you for hosting us. And thank you for not just your great talk, but that nice lead in. It's always great to see you and speak with you and hear you speak. So I will attempt to do what Burton had said I might. I won't go into all the details, and I don't even know if I remember them, but I've known Burton since 1998, when our U.S. market had the bubble, when all everybody cared about was Cisco, selling at 50 times sales. And what happened was I saw a company change its name from KTEL to KTEL.com. Like some of us here in the audience, my first book I read out of school was A Random Walk Down Wall Street. And I saw a company change its name in 1998 from KTEL to KTEL.com. The stock went from $1 to 35, and I said, oh my gosh, I've read about this. And I found my copy of A Random Walk, and sure enough, there was a quote from Jack Dreyfus from the 1960s bubble, and I used the internet to find Burton, early workings of the internet, and his Princeton website had a phone number, and I picked up the phone and dialed it, and he answered, which I sort of thought maybe somebody else would answer, but I said, well, gee, Dr. Malkiel, I don't know you, but I said, I don't know you, but I read your book, and you should see this. It's right out of your book. And 20 years later, we're here, and I'm excited to be here, and thank you again for being who you are. So I've worked, Burton dragged me into China. In 2006, we had been working on some stuff together, and Burton had gotten interested in China. I believe there was a couple of his former students that were back in China and said, hey, Burton, and feel free to chime in if I'm not describing this exactly accurately, but China's coming back. We're actually quite capitalist, and this is a real thing, and you should come and take a look at this. And Burton and these two gentlemen ended up publishing a piece in the Journal of Investment Consulting, and I read it. I had never been to China before, but I read that piece, and it made sense, and it all filled in some blanks that I didn't really quite appreciate about China and its history and its economy. And at the time, we had a number of clients from Google. We had a business called Active Index Advisors, which was a sort of a precursor of what robo-advisors offer from an investment strategy, and we had some Google clients, and they had heard about Burton's China paper. They asked if Burton could come down and give a talk about China at the Google campus in 2006, I believe, and I didn't realize it the day we drove down to Mountain View, but I basically got sucked into China and emerging markets, and I'm still there. So let me tell you what I think, if I could summarize what I've learned in that period about emerging markets in China, about their stock markets. I'll tell you the negative side, I'll tell you the positive side, and then hopefully I'll convince you that there's I believe, a fantastic way to participate in the emergence of these economies, and thanks to our friends at Han, now available easily to some of you as an investment product. So what are emerging markets? 60% Asia. This is both in terms of people and market cap. 60%, 20% South America, 10% here, and 10% Eastern Europe. So that's what they are. There's no official definition, and in fact, MSCI and FTSE disagree a little bit and have historically disagreed. Is Korea this? Is Korea that? Are China A shares in or out? But this is basically, we're talking about the world. As Burton's slide showed, this is 85% of the world's people, 90% of the world's young people. Here's the biggest problem, and I remember this basically on day one when Burton gave his China talk and a couple of the Google engineers that were clients said to us, we want to invest in China. And I said, okay, well, how do we do that? Well, of course, we're going to try to use ETFs. And I said to, and by the way, let me confess, I'm a Warren Buffett person first and foremost. When I started my career, that's what they told me to be. I read all the Berkshire, I read A Random Walk Down Wall Street before I even started, over the weekend after they hired me on a Friday, and told me to come in Monday. And, but I spent my time trying to understand, what does this Warren Buffett guy do? And it was the annual report from 1995, which I got on a Thursday in the mail when I got home from the office and started reading Thursday afternoon. And there was a quote from Warren Buffett saying, most investors, both institutional and individual, should buy index funds. And that blew my head up. And I told my friends, I'm not going out tonight. I have to stay home and try to sort this out. But so I come to the indexing world with that sort of original foundation. And so I look at the companies. And so I said to the index people, well, show me what's in the index. And Burton, I think both in the paper and in conversation, had warned me the top 10 holdings are going to be Chinese banks and oil companies. And these things don't work like a traditional Western for-profit operation. And the example was a Chinese manufacturer in a second-tier city that employs 10 or 15,000 people. It's inefficient. It's got corruption and malfeasance perhaps associated with it. And it needs more money. It's out of money again. And it goes across town to the Chinese state-owned bank and says, we need more money. And rather than say, well, you didn't pay back the last money, it says, well, we can't lay off these 15,000 people, and let's then make you another loan. And that just bothered me from the beginning, that I'm looking at this list of the companies of the index, and essentially all of the top 10, the Chinese policy banks, the oil and various energy companies, a couple of phone companies in there too, they weren't really, when they showed up on Monday morning to work, maximizing shareholder value for Western investors wasn't really on the list. And that bothered me. And Petrobras has become the poster child for this. I mean, Petrobras is the gift that keeps on giving to me. You can't quite see the picture, but most of you, I'm sure, know, if you read the papers at all, Brazil has been taken down by this Petrobras scandal. You've got a large percentage of the government, corporate leaders, even soccer stars that have been implicated in a wide range of corrupt activities, kickbacks associated with contracts with the state-owned oil company. And in fact, the three last, the current and previous two presidents have been implicated, and one of them is currently in prison, and he's in a building that has a plaque on the outside with his name on it, because he was the president when they commemorated the prison, and now he's incarcerated inside of it. So, I mean, that's all Petrobras, again, is the poster child for what is wrong with state-owned enterprises, and they represent about a third of the index, right? So if you buy a broad MSCI or FTSE ETF or index fund, you're going to get a whole lot of Chinese banks, Chinese oil companies, Petrobras in the index, 4 places, local share, preferred share, ADR, et cetera. So that's the problem. To me, that's the biggest problem. There are other problems with weightings. Taiwan, which isn't a very big population, has twice as large of a representation in the index as India, which has a 1 point something billion people versus 25 million perhaps for Taiwan. I don't have a solution to that problem, and it's just one of the issues when you take 20 or so countries and mush them all together and try to say they're all in one category, and certain ones have larger market caps and public companies, but maybe the growth isn't going to be in those countries. Korea, another example. So I think there's a lot of problems, as Burton, I think, alluded to a little bit, in taking indexing and trying to apply it to this huge part of the world that's very different in so many ways from country to country and region to region. So, and it's not just Petrobras. China's got these so-called economic fugitives that are hiding in the United States and Canada. We're starting to help send them back now. The chaebol in Korea are not part of my 30%, but they have some similar issues. This is the third-generation chairman getting led away in handcuffs for bribing the president of Korea, who was impeached. Botox injections were part of the bribery, according to the Wall Street Journal. So that's the biggest problem. There's other problems, and particularly in frontier market indexes. But let me then switch to what is the positive story and the growth story. I mean, the thing that's emerging in emerging markets are the people, right? You have billions of people, 90% of the world's people under the age of 30 are moving on up. And they want more and better food, more and better clothing. They want appliances and dishwashers and automobiles, and they want their kids to go to an Ivy League school to get a good education from people like Burton. And that's the story. That is what's emerging. And I didn't, Burton didn't say, let's do China, and I went out and, backpacked around and came back and said, I figured it out. They told me this the first day, right? This is all about the consumer. Almost every major investment bank or consulting firm has some version of this report. This comes from McKinsey. McKinsey calls it the greatest growth opportunity in the history of capitalism. And basically, again, and anybody that wants these slides, we can certainly send them to you if you talk to Hector and his team. But basically, you got billions of people becoming consumers. That's the story. And so pretty much from the day that Burton gave this talk at Google, and the Google people said, that sounds like a good idea, and I had to sort of sort out how to do that. My battle has been, how do we take the index and all of the state-owned legacy oil, banking, etc., and push that down and raise up the exposure to the consumer, which was maybe 10 or 12% of the index, versus 40 or 50% for financials and 30 or so for oil and so forth. So this is the story. If you want to get exposure to the growth of emerging markets, you figure out how to get participation in this large trend. And as I say, even if McKinsey's wrong and it's only the second or third biggest opportunity in the history of capitalism, it's worth maybe knowing when you show up with your money to buy something in emerging markets. So again, the quote from McKinsey, $30 trillion by 2025, the amount of consumption in the emerging markets. So, and now let me tell you part of how this, how EMQQ came to be. So in the United States, Burton and I were involved with a firm called Guggenheim Partners and developed several China-focused ETFs. And so people knew that I was, now they have the Invesco brand on them. Invesco acquired the Guggenheim ETFs in the US. People would call me on the phone and they'd say, what's the best emerging markets ETF to buy? And I didn't tell them to buy any of the China funds that we made with Guggenheim. I told them to buy the emerging market consumer ETF. It wasn't my ETF. It had the ticker symbol ECON, and it owned the Walmart of Mexico, the Coca-Cola of Indonesia, traditional consumption types of stocks. And one day I got a call from a friend who had a young daughter and said, my daughter's 3, I've got a few bucks around, I want something to buy for the next 15 years to pay for her college. What's the best emerging markets ETF to buy? And I started to tell her to buy Econ, the food, beer, big box retailers of the developing world. But I caught myself because I had recently parted ways with a group that Burton and I both had worked with and helped set up and still operating, that was a sort of quantitative approach to emerging markets. And I had said, you know what, I'm going to do my Warren Buffett meets emerging markets thing. And I bought 6 or 8 stocks. And I went around town to it was a family and friends sort of fund that we still run. And I made a few slides to show a couple of these people, and I listed the stocks that I owned, and sure enough, the first few were from econ. They were Chinese snack food companies, Chinese basketball shoe makers. But the second column were things like the Craigslist of China. And I looked at that slide and I said, you know, these food and beer companies are great. They're entrepreneurial. They have perhaps have a moat, high returns on equity and assets. And they're growing at 15 or 20%. And the founders own the same class of shares that we do, so we feel good about those. On the right side of that slide were, again, the Craigslist of China. And I looked at those, and those were growing at 120%. And in the case of this, the Craigslist of China, Wuba, which trades on the New York Stock Exchange, had a 94% gross margin, which I still have never seen in another company. It's down to 91, but still quite healthy. So I was witnessing that the old way was losing out to the new way. And in fact, I was seeing this in my driveway. My family, I live 15 miles directly east of San Francisco, a town called Lafayette. My family used to drive to Target 4 times a week, 5 times a week. That was easy to do. We have an SUV, the roads are paved, there is a Target, free parking. But all of a sudden, a truck would show up once a week in my driveway and put a box on my front porch. And basically, in the last 5 years, Target visits maybe once a month, deliveries to my home 20 times a week. Literally. I can tell what color the truck is by the sound now. So the way we consume has changed quite dramatically. And if you map that over to emerging markets, and you map that over to this incredible wave of emerging market consumers, you end up with, well, if McKinsey's right that the consumer in emerging markets is the greatest growth story in the history of capitalism, this is the best chapter by far. Because there's a leapfrogging going on. For us, this was evolutionary. We had computers that were this deep on our desk, and then they became this thick, then they flipped open and could go in your backpack, and now they're in our pocket. Most of the world never had that. So when somebody in the developing world gets a smartphone, it is most likely their first ever computer. And by the way, this is an Android-based phenomenon for the most part. There are rich people everywhere. There are certainly rich people in Eastern China. They like iPhones. Many of them buy iPhones. But if you're in Chongqing, you're in India, you're in Nigeria, the odds are you're looking for something that's $50 or $100. It might be a used iPhone coming from America, but more likely it's being made by a Chinese manufacturer, Xiaomi, Huawei, Oppo, and it's a $50 or $100 phone. It's getting cheaper every year. It's getting better every year. It may not have 1 billion pixels. It may not store 500 movies, but it gets the internet. And that's what this shows you here. Basically, mobile broadband is the cable for the world, right? We've had telephone line access to the internet. We've had high-speed cable. Most of the world is leapfrogging this and going to mobile broadband. In India right now, there's a lot of excitement, and part of it's because Reliance Industries has essentially started giving away the internet, broadband mobile. They chopped the price way down, and you have millions and millions of people every week and month getting the internet for the first time on a $50 smartphone. And it's changing the way these people live, what they know, and as they become consumers, they're doing so as digital natives. Again, leapfrogging the way we do things here. you can see in this slide, you probably can't see it, but basically it's still early. China with 700 million plus smartphone users is still only half penetrated. And again, the real growth story is down here in India. As Burton said, the growth rate for India is the fastest in the world, at least right now. China and India have been kind of neck and neck and back and forth for the last 3 years, but in the online space, this is where the growth is. And if you look at this, you see India's got 300 million smartphones, 1.3 billion people, and so only 20%, a little more than 20% of India has a smartphone, which means essentially you have 1 billion people in India that don't have a computer yet, and they don't have the internet yet, but they're getting it fast. And in other countries like Vietnam, Indonesia, etc., lots and lots of people coming online for the first time. I'm going to skip some of these slides, but basically this is the story. You've taken this giant consumer wave, you're giving them their first internet connection on a smartphone, their first computer, and the final piece of this puzzle, and this is going to circle this back to the corporate governance issue. Most of these internet companies are being backed by Western venture capital, private equity, institutional investors. So in a part of the world where corporate governance is terrible, you've got Ivy League endowment money going through Silicon Valley venture funds and funding these local entrepreneurs. In the case of Alibaba, in addition to SoftBank, you had Jerry Yang at Yahoo. Now, he got fired from Yahoo for investing $1 billion into Alibaba. That turned out to be the only thing they had of value, and I think it's currently worth 60 times what they paid for it. In the case of the Indian e-commerce leader, Flipkart with a K, backed by, amongst other investors, Mark Zuckerberg's family office, Iconic, in San Francisco. So this is how this is happening. Local entrepreneurs, most of whom have backgrounds working for our leading internet companies, decide it's time to go solo. They get funded, they get good corporate governance, and they list on the New York Stock Exchange or the NASDAQ. And in fact, one of the issues the first day when I said, okay, fine, give me the list of all the Chinese companies, I got to the bottom of the list and I said, where's Baidu? And the index people said, well, we don't include Baidu. And I said, well, what do you mean you don't include Baidu? And the index people said, well, we don't consider it to be a Chinese company. And I said, well, that's funny because I only know 2 Chinese companies. One of them is Tsingtao, which makes beer, which I like to drink with my pot stickers. And the other one is Baidu, which is the Google of China. And being the Google of anything sounds like a good idea. And being the Google of the biggest country in the world sounds like a really good idea. But because these companies are backed by largely US institutions, they want to list on the best exchanges, which are the, in addition to the London Stock Exchange, the New York Stock Exchange, and the NASDAQ, and the Milan Stock Exchange. So, you know, the Borsa Italiana. So this is the final piece of this puzzle. You've got this great wave of consumers getting computers, getting the internet, getting backed by Western investors, and this is the money slide, literally. I have a $100,000 US dollar reward for anybody that can show me a sector of publicly traded companies that have ever grown like this. So there's presently, the Emerging Markets Internet Index that we have, that Hector's firm's ETF is based on, has 58 companies today. And this shows you the total revenue and revenue growth rate for those companies. And it's averaged over 40% for the last 8 years. And as far as I can tell, and I've asked a lot of people with a lot of experience and wisdom, if they know any sector that's ever done anything like this. And I so far have not, the reward used to be $10,000, but as after a year of pondering and proposing it and not getting any challenges, I raised it, and after I asked Burton about it, if he knew anything, then I said, all right, and it sounds better to say $100,000. So, and I'm quite confident that nobody will find an answer that beats what I'm proposing, but I could be wrong. This is incredible, right? I mean, this would be incredible for a single company, but this is a whole sector. And again, you can see that the numbers are slowing. It only grew at 36% last year, but that's still, that's fast. That's a lot of growth. And I would also point out Alibaba, their last quarter was a 61% top line number. So this is why I'm here, right? You want to capture the growth anywhere in the world, this is it, right? And again, as I said, I don't think there's anything that's ever preceded this in terms of sectors of publicly traded companies. The closest challenge we've got were the robotics people, which like to pound their chest and tell you that they've got 18% growth. So that's why we made this. But of course, as Burton said, economic growth doesn't really correlate with stock price returns. And in fact, fundamental growth of individual companies doesn't necessarily correlate, and certainly doesn't correlate on a one-to-one basis with the fundamentals. While you can see here, there's been this sort of lost decade in the traditional emerging market indexes, which are weighed down by Petrobras and the Agricultural Bank of China, et cetera. Longer-term investors in these companies have done quite fine, except for the last 6 months. And so I would suggest that now's the time. And I will share some valuation numbers with you. I don't, as Burton likes to say, I've never met anybody that can time the market, and I've never met anybody that's met anybody that can time the market. So I agree with that. And again, we've had a good decline. We could have another, further decline. But the valuations right now look quite good. The PE multiple for these stocks, the forward numbers might be a little lower, as Burton said, but the PE that I have in my head and in my data right now is about 26 or 27. Top line growth, more than that. So you got a PEG ratio. I like to use the revenue growth for the PEG ratio because that's your fundamental growth. I mean, you can have a dying business and buy back stock and grow your earnings, but fundamental growth starts at the top line. You got a PEG ratio of, call it 0.75, 0.8. The S&P 500, if you use the Shiller number, it's a 30-something, but let's say it's 25 or 30. S&P revenue growth is sort of 5%-ish, so you're paying 4 times the growth rate for the U.S. market, and these things are presently selling at a fraction of that. And I think that the backdrop, the negativity, the trade wars have all sort of affected that in the last 6 or 8 months. So lots of growth, value creation. As mentioned, most of these companies were not in the index. And I spent way too much time in my life telling people, Baidu's not in the index, Baidu's not in the index. Fortunately, the Alibaba IPO put this on the front pages, and even some of the mainstream media pointed out the idea that Alibaba wasn't actually going to be in the indexes. And that's been finally remedied, but only recently. So I'll just touch on a couple of the other companies that are part of the story. Tencent. I'll assume most of you know Tencent, but this is the Facebook of China. We use terms like that to help make it simple for people to understand. Facebook's not the Tencent of the United States. But Tencent is the Facebook of China, but it's also the Netflix of China. It's also the video games of the United States. They have half ownership in the popular U.S. video game and are the leading video gaming company. Tencent's also had quite an incredible return in this. You can see the S&P 500 and the emerging market indexes on here for the last decade, and yes, a lost decade, but people investing in Tencent have been quite thrilled. And again, that's just an example. Craigslist of China, Mercado Libre, which is both the Amazon.com and PayPal from Mexico to Brazil and everywhere in between. In Russia, you have Yandex, which is both the Google of Russia and the Uber of Russia now. And in India, most of the companies in this space presently are private, but there are a few publicly traded. This is the, call it the Expedia of India. You may or may not have seen that Berkshire Hathaway invested in the Indian leader in payments, Paytm, which is private, and 40% owned by Alibaba. So even Berkshire Hathaway is now investing in emerging markets, internet companies. And the final thing I will just point out related to private companies is inside of EMQQ, in addition to the 58 public companies, are about 300 private companies. Not because we're out there buying, making investments in venture capital rounds, but because Alibaba, Tencent, JD, Naspers, these are some of the largest venture investors in the world now. Here are a few examples of investments in the Tencent portfolio. Mobike, bike sharing, which is a very big deal in China. The density of China makes some of these business models work better. Flipkart, the Indian leader, which Walmart just acquired 78% of. And finally, Didi. And Didi, how many of you know Didi? D-I-D-I. Okay, well, I can tell you with some confidence that within a year or 18 months, all of you will know what Didi is. And some of you will get calls from clients or associates talking about Didi. Didi is the leading car-hailing app in China. And the way that the business came together, the reason you're going to hear about this is because it's going to go public. And it's probably going to go public in the United States, and it's going to be a big deal because it's a big company and it's an exciting company. When the U.S. ride-hailing business got started, when Lyft and Uber were taking off, two companies sprouted up in China to basically copy this. One was called Didi-A, one was called Quadai-A, one was backed by Alibaba, one was backed by Tencent. Both of them had about half the market, 50% market share. They were both growing at incredible rates. All of a sudden, San Francisco-based Uber announced, we're going to China. We've got $3.5 billion. We're going to take over the Chinese market. And Alibaba and Tencent looked at each other and said, let's merge. And so Alibaba and Tencent took their two ride-hailing apps and merged them to form Didi Chuxing, which essentially was a monopoly at that moment. Uber showed up, competed, spent their $3.5 billion, got a very small market share, and said, we're out of here. They went to Didi, to the president, Jean Shu, who's an incredible woman and very awesome executive and extremely articulate. Her father's actually the chairman of Lenovo. She's the president of Didi. So Didi said, here, Jean, take the keys and give us some stock, and we're going to go back and sort out our problems. And this company will IPO. And the reason I'm so confident, we tell this to U.S. financial advisors that are calling on individual investors, your phone's going to ring. Because this woman is a stud, and she's going to be on TV, and it's going to say, the Uber of China, and she's going to talk, and people are going to say, that's cool, and that seems like something I want to invest in. So if you haven't heard of Didi yet, you almost certainly will in the coming, but probably the end of next year, let's say. So in summary, I think this is, obviously I'm biased. I have a product that helps investors get exposure to this, but this is where the growth is. I believe it's unprecedented. If you can show me that it has happened before, I'll give you some money. You get great governance in a part of the world where governance is the biggest problem, in my opinion. And you get exposure to not just these public companies and not just emerging markets, but you get exposure to frontier markets and to a lot of the next Alibabas and the next Ubers. So that's my part of the talk. And I think that now we do a Q&A?
Yes, correct.
So, thank you.
Thank you, guys. That was terrific. Now, if you've got questions, can you just wait for a microphone to come to you? Who's first?
Yeah.
It's recording for the
Okay. Yeah.
speaker.
Yeah. Mauro P27. I was wondering if you put any considerations about currencies and if there's a currency hedge version of your funds, or are those numbers in US dollars, etc.
Those are, first of all, no, we don't do any currency hedging. About 70 to 75% of the companies actually trade in the United States, so that they're trading in US dollars, although the businesses are operating in different currencies, but we do not hedge. And frankly, I don't know much about currency hedging, except that Burton mentioned Cisco. And I've started a few businesses over the years, and every time that they start, there's always one trend that's very prominent. And in the first business, the question that was most common was Cisco. When I started this business, the most common question I got was, do you hedge for the currency? Nobody had ever asked me that question before, so it struck me that people probably already lost a bunch of money by not doing that, and that's why they were asking about it. But the answer is no, we don't do that.
I think the empirical work suggests that equity funds in general have not been enhanced by people who have done currency hedging. Those who buy emerging market debt that is denominated in local dollars have had benefits from currency hedging, but it has not been the case for equity markets.
Thank you. You've got a question down here. Thanks, Simon.
Should I? I had a question regarding the exposure of the index. I mean, I'm the market maker in this here in London, and we saw a bit of a sell-off in the sector during the first week of the launch, but that was more related to talks about tariffs and trade relationships globally. Does the index, in your view, sort of weather the storm, so to speak, in terms of that, or is it, what are your thoughts around that, and is this a problem that you need to be concerned with?
Well, I would say first, the fundamentals of the companies that are part of EMQQ are probably the least likely to be affected by the tariffs. I mean, the tariffs about steel and sorghum and pig's feet and tires and things like that. And this is, people are not walking around the streets of China buying rolled steel on their Alibaba account. They're getting car rides, food delivery, et cetera. So I think of all the sectors, I mean, the state-owned legacy manufacturing, that strikes me as the area most likely to be affected fundamentally. But as we know, that doesn't mean the stocks don't go down. And in fact, EMQQ has gone down more than the broad indexes since these fears were raised in the market. And I'd like to think that in the short term, investors will look through that, but I think the reality is that it's not likely. If emerging markets go down, it's not likely that EMQQ is going to go up, even if the fundamentals aren't affected.
Look, there's no doubt about the fact that as you get into a trade war and people get their backs up and there's saving face in terms of what, say, the Chinese can do with negotiating with the United States, there's a danger. And a full-fledged trade war that encompassed the whole world is not good for the world economy. And I think it's one of the reasons why you have such a unique opportunity now. The question, I would say, is I can't tell you that this is all going to blow over and be fine, but I do believe that in the long run, the insight of David Ricardo centuries ago that the reason we don't want this to get out of hand and to completely stop the world trading is that there's no question it's not a negative-sum game. It is a positive-sum game for the world. And eventually, when this is, maybe a year, 2 years, 5 years from now, I think the world is not going to go back from that fundamental insight because it's absolutely correct, and the world is not better off becoming insular and where trade stops, even if there may be more dangers immediately ahead.
One last question.
Just a question on currency again. And do you worry about too much of being borrowed in US dollars and a problem with the Asian currencies, particularly?
Well, to be totally fair, I have no opinion about that. Burton may have, I think Burton takes and has obviously more experience, but more of a global economic view than myself.
Certainly, you particularly worry about the debt that is denominated in dollars and that is owned by foreigners. Fortunately, in places where there's a lot of worry now, and there's a lot of worry about China, I would say two things: that most all of it is held internally. Even though there's some external, it is held internally. And if you think of what got us in trouble during the recent 2008 debacle, was not only indebtedness, but the indebtedness affected our financial institutions and affected our consumers. One of the reasons the United States economy went south is that the debt to income ratio for consumers had been in the early 2000s 30%. But as this housing bubble went on and people were buying houses with nothing down, people were making so-called ninja loans, loans to people with no income, no job, no assets. The debt-to-income ratio of individuals got to 130%. And that combination of the financial institutions being over-leveraged and the individuals being over-leveraged was a disaster. Now, in China, there is no doubt that some of their, and these are the state-owned banks, are over-leveraged. But individuals, oh, and incidentally, what happened in the United States is savings rates went to zero. The Chinese are still saving 40% of their income. So the whole, I mean, to the extent that we're talking about Kevin's companies, individuals are in much better shape. And since the debt is held individually and the official government debt to GDP ratio is actually low in China relative to the United States, the Chinese government will print the money and bail them out. And the individuals are not in trouble. They are, in fact, over-saving. And you see that throughout Southeast Asia. You see that also in India. And it's one of the reasons why debt can get you in a lot of trouble. And there is too much debt around in the world. But I think it is less of a problem than the popular press has suggested.
Thank you. Well, on that note, can I introduce Hector McNeil, the H in Han, to point the way ahead for us. Thank you. And thank you, guys. Really terrific.
I'd just like to say a massive thank you to Burton. The first time I've heard him speak, and it was fantastic. To Kevin as well, who I've got to know very well over the last couple of weeks. And you know, I'm totally convinced by the stories, the fact that I've bought some of EMQQ in my own portfolio. Just want to say a few words. Han actually, as George rightly points out, is not to do with the Han dynasty. So we're not anything to do with Chinese stocks or ETFs. We are what we call a white label ETF company. We're the first type in Europe. And I think you can see from the debut fund we have, we're going to have some very interesting and some very different products available to you. So I don't want to say too much more because ultimately, you know, what we're going to be able to say in probably 2-3 years' time, hopefully with a similar growth profile to that, when we've got 150, 200 products, you know, we'll have a lot more interesting stories to tell. We've also recently listed a cloud computing product and also something along the same sort of story, a global innovation fund which looks at all the mega trends that are going on in the world currently around consumerism and cloud, augmented reality, those sorts of trends that we're seeing out there. So very thematic and very current growth stories. But I do think that you know, it's been a great session today, and I think very insightful. And you know, I think we're going to have some drinks and a get together now where you can all obviously have a chance to talk to the gentleman again. I'd like to say thanks to the SKUs Institute as well, who yet again have been great hosts to us, and obviously thanks to everybody here as well for attending. Thank you very much. Cheers.